in preparation for this, I thought it would be a good idea just to double check what the average turnover rates are. And my usual sort, I couldn't get access to it last night, but there's a few remarks available through searches which indicate that, say, US mutual funds, US domestic mutual funds, which is not a direct comparison for what we do, but let's use it. Average turnover rates are 65 to 70%. They have in fact been coming down from well over 100%, but one of the reasons for that is the growth of passive strategies in the States. So it's not always a true and fair view of other active managers. So that speaks to what you said. We're there to save all the money you mentioned. Those are byproducts. The reason that we have turnover is having put all that energy, as you said, into finding Keysight and having that buttressed by corroboration that it's in the right place and that its execution is good and so on. That means the investment decision is we're buying into the prospect of it performing and developing its business model over years. So a 20% turnover rate implies an average holding period of about 5 years. There are 18 stocks in this fund that we put in on the first day we started running it. Actually, I'm mildly disappointed by that. I think the number will tend to rise as we look at rolling 5-year periods. So what makes us sell? Things change. We can have errors of research. We make mistakes. We manufacture mistakes. And once you've done it, and that's often where optimism gets in the way of the facts and the balance between the two. And right now we're in a period of intense optimism about some technology companies and some media companies, and that is justified. It's the balance of that and the probability that they will meet their outcome. Second thing is sometimes things just get really overvalued. You get 4 or 5 years return in 4 or 5 months, and you have to be a big boy and accept that when that lands in your lap, you should not try and fight it and say thanks very much, because we have a bench, we have candidates that we can put in the portfolio, and if something's risen, then the dividend yield has fallen. The price paid for that dividend growth rate has gone up, so we can redeploy that capital elsewhere. But often it's because things really change. So, we owned a company called WPP at the beginning, which is a big global advertising conglomerate, and it did well for a while. But in the period that we've owned that, advertising has moved away significantly from the agencies towards others. The thing that we would be most embarrassed by is owning a stock that out the blue cut its dividend because of business problems that we had failed to spot. I'm sure we will be embarrassed by that one day. But if we can keep the number of those to the barest minimum, that would be not so much a success, but the lowest possible level of failure. We should put a Keysight technology on our error rates in that. So that's why we sell. We do have some portfolio limits in terms of diversification and size of positions. I don't call that selling. That's just applying your discipline. But in terms of what you said, that's why we let things go. We have made mistakes, and we just need to get better and better at seeing them earlier.